Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, November 23rd, 2019, and this is the weekly market update. So in this week's reality check, I want to talk about contrarian investing as it applies to oil again, and point out that one of the all-time greatest contrarian investors, at least as it relates to real estate, has now been putting money into distressed oil companies. And the guy's name is Sam Zell. He made his billions. He's a billionaire. He made his billions basically buying real estate when it was out of favor, mostly in New York City. But he made his billions in that as real estate recovered. And now he was recently on CNBC last week, and there were some articles about this. And he was discussing why he's now putting money into the oil patch. And I'll post a link to the videos, like a short 5-minute video that's on YouTube from CNBC. Now, just because Sam Zell made billions of dollars buying distressed real estate and made that work doesn't make him some guru. And just because he's getting into oil, that doesn't mean that he is going to be successful in calling the bottom here on oil and riding it up. What it does demonstrate, though, that is that the mentality of contrarianism, the ability to recognize a contrarian situation, is pulling Sam Zell into this investing or speculating on distressed oil companies. So what he's saying here is something that we have been talking about. The amount of capital available in the oil patch is disappearing, Zell said Thursday. I compared it to the real estate industry in the early 1990s, where you had empty buildings all over the place. Nobody had cash. What we are seeing are situations where companies are taking steps in anticipation of problems rather than responding to problems. And we've talked about that before. These companies don't have the ability to drill anymore because the capital markets have been cut off to them. They can't issue debt. They can't issue equity because many of their stock prices have collapsed. And basically, a lot of these oil properties don't work. So, on a cash flow basis. So what they're doing is, in one of the articles in Bloomberg, they highlighted one of the deals with a company in California. Basically, they put money in, and Zell and his investors get their money back after the wells come online. They get all of the cash flow until they are paid out with some return added to that. So I don't know how good of a deal this is for the oil companies, but certainly, when you have cash and you can buy distressed assets or you can cut deals, you can determine to the borrower or to the person that needs capital terms. So this is a situation where these people need money and they're willing to have all the cash flow go to Zell and his investors until they're paid back their investment for drilling the wells and then some negotiated return. And this just further stipulates what's going on in the U.S. shale. It was a bubble. It's popped. It's going to collapse like all other bubbles have, and it's not coming back. And the thing that's, I find fascinating and interesting is that if you believe that oil demand is going to go away, then this might be reflected in the stock prices. But I don't see that as what's happening. I just don't see electric vehicles displacing internal combustion engines to the level that many pundits are extrapolating out into the future. So, certainly not in the third world in the emerging markets. People can't afford $65,000 cars. So, and the other thing is people don't understand where a barrel, the total barrel of oil, 45 to 50% of it goes to gasoline, but the other half of the barrel of oil is processed into other constituents like heating oil, kerosene or jet fuel, plastics, petrochemicals, all kinds of other things that are not really going be able to be replaced by solar panels and wind turbines. I mean, the inability of people to really drill down and understand these things is really where our advantage comes. So when I see somebody that's been successful buying distressed assets in the past, now stepping in and entering a area that we're involved in, that we are contrarians on, it has us sit up to take notice. Doesn't necessarily mean he's going to be successful, but he has been successful with a contrarian mindset. So he's bringing that to this particular industry, which I find positive, and I like the thought process as in third bullet point. You know, the amount of capital available is disappearing. We know why that is. So this provides an opportunity for those with capital to extract terms that are beneficial to them. Now, the other contrarian thing I wanted to talk about was on Zero Hedge. I'll put a link to this article also. Is that this guy, Andy Hall, who was a legendary oil trader back in the day when oil was booming. He was a perma-bull on oil. He has now become a bear on oil. And here's a quote. He says, "There's a non-zero chance that by 2030, which is only basically 10 years from now, we will see a plateauing or a decline in global oil consumption. It'll happen because of technology, electric cars, and renewable energy." Here we are again, where I think somebody is taking current growth rates in electric vehicles from a very low base and extrapolating that out 10 or 20 years, with no discussion about where the nickel comes from, where the cobalt comes from, how you get the costs down. You know, batteries are not microchips. One of the reasons why batteries have went down in price is not because of technological advancement. It's a chemical process. It's not like a microchip where the power of the microchip doubles every 2 years or 18 months and the cost halves. You are limited with battery chemistry because of the constituent materials that go into it, i.e. nickel, i.e. lithium, i.e. cobalt. If you want to have 30 or 40 million, or displace 50% of the internal combustion engine fleet with electric vehicles, with the current battery technology and the constituent metals, they don't exist. They will consume an inordinate amount of material that does not exist. There is not enough copper and nickel and cobalt currently available to get us to 2030 to displace all of this oil. Now, I'm not saying it can't happen. You know, if the prices go up sufficiently, believe me, there'll be sufficient capacity brought on, but it won't happen in a day or two. And we are hedged there. I mean, I believe that electric vehicles are going to increase in number. I believe that Western governments, in their zeal and their religious fervor in the West to combat a non-issue of CO2 in the atmosphere, are going to mandate that people buy these things. That's what's going to come down to. It's already happening in some European countries. So of course it will grow. But again, the growth is not in the Western democracies. They are in decline. Growth is in Asia and in the emerging and frontier markets. And these people cannot afford $65,000 and $50,000 cars. You know, nobody answers me any of these questions. Like, where does after the battery basically is wasted after 10 years, you got to get rid of it. How do you recycle it? What do you do with it? Right now, we don't have the ability to recycle these things efficiently. You know, and just coming to me and say, well, we'll figure it out, that doesn't work. Same thing with solar panels. You know, I'm seeing repowers that they're doing on wind towers, wind projects, where they're basically the first generation technology that was put in the ground, I don't know, 12, 15 years ago. You can now put bigger and more efficient machines in those current windy locations. So they take down the old turbine, or they just take down the power part called the nacelle and change out the blades and bigger blades. But what do you do with all these fiberglass blades? They're having landfills don't want them. They can't be really recycled very well. So I've seen them in West Texas piled up just on, lots piled up. What are they going to do with them? I don't know. So these things aren't really thought through. They're just, people just say it because they want to believe. But you can't just take a current growth rate from some small base like EVs and extrapolate it out 10 years and say that's where we're going to go. That's very dangerous, linear extrapolation, with no idea of the footnotes that need to go along with that. Like, okay, if I'm going to, have all these millions and tens of millions of electric vehicles, where does all the materials come from? So going back to this contrary indicator, this legendary oil trader who was a bull, made a lot of money in oil, is now a bear, and he's kind of making some assumptions here too. And the article doesn't really go into his thought process, but this is what he says. You know, it'll happen because of technology. Okay, well, like I said last week, I'm on interstellar star travel. Eventually, technology will enable it, I'm sure, but not in any time frame that I care about. Electric cars, we just make this random electric car and renewable energy um, assumption. You know, the renewable energy thing's funny because I'll give you another detail. I got my electric bill this month, and being that's coming up to the last part of the year, I became involved as part of my electric co-op, a industrial scale shared solar project. So basically you bought in to a certain percentage. Like I displaced like 30% of my electrical consumption with solar panels, not on my house, but out in a field over near Corpus Christi, because that's really more efficient than putting them on your house. And I get the benefit of the portion of the solar that I purchased for the period of the life of the panels, which is 30 years, 25 years, whatever it is. And I have an excellent software package that's provided with it so I can track it in real time. It tells me how much I've displaced of carbon, how many trees I've saved. But you know another thing it shows me? It shows me the production throughout the year. And guess what? Even here in South Texas, where we have a lot of sun in these winter months, because of the, seasonal changes of the Earth as it rotates around the sun, guess what? Solar production goes down by the displacement of my bill goes down sometimes by 30, 40, 50% in these months around October, November, December, and January. Again, another small detail that people don't think about. Now, people would say, well, John, you're a hypocrite. No, I'm not a hypocrite. I totally detest subsidies, okay, as a political argument. But if the government is going to give me 30% of my capital cost in a tax credit, it stimulates every fiber of my greed. You know, with this package that I have, I'm basically, the money that I put into it for the capital cost was offset by 30% by the federal government, and my cash-on-cash yield is about 9.8%. So I get a 9.8% return on this investment. Why wouldn't I do it? That's exactly what Warren Buffett does. That's the whole basis of why he bought Mid-American Energy and why he does all these renewable projects. That's a pretty decent return in a zero return world. 9.7 to 9.8%, somewhere around that range I calculated. Now, if I put them on my house, your return will drop because that's less efficient. You want to be, if you can get involved in a community solar or an industrial scale project like that, it's more efficient and you will have a better return. But I do notice that it varies throughout the year, the production. Now, I've had it going for like 3 years now. It saves me money. I get a good return. But, I still don't think you can't power the world like that. When you do seasonality or certain months where we had a lot of cloud cover because we had a lot of rain or whatever, you can see where the production drops. People forget these things. So when I see a guy like legendary oil trader who made billions of dollars on oil now becoming a bear, I think back to what Don Cox said. I've talked about Don Cox before. He's a big money manager at BMO Capital Markets. He used to have a weekly call. And what he used to say about contrarian indicators, especially in commodity markets, was when those who know it best love it least because they have been hurt the most, you are potentially looking at a bottom in that particular market. So this is just another piece of the puzzle. I'm not saying this is the bottom. I'm not saying rush out and buy oil stocks. People know what I think about it. I think that, if I can get 20 to 25% cash flow yields out of these Canadian producers, I'm going to like that. I think that, with what's happening in the oil patch, shale oil patch in the U.S. is going to lead us to suffer higher oil prices because of the lack of investment that took place in other areas around the world as shale artificially pushed down the price of oil, and the incentive price was therefore lower and didn't incentivize new production outside of the shale patch. You guys know the story, know the history, know my thinking on it. But this has served me well before, and I believe it will serve us again well. Again, when those who know it best, a guy like Andy Hall, who made billions in the oil market and was a trader, love it least, which he doesn't love it now. He's a bear because, he sees oil demand plateauing in 10 years because they've been hurt the most. He basically had to close his fund up after it blew up on him. So I think this could be, just another contrarian indicator. You take that piece with the Sam Zell piece, and things keep falling in place. That we could be at an inflection point. So I wanted to talk about Marine Money New York City that happened last week. It's a shipping conference that happened, and I'll put a link to the presentation that I was able to. I forget where I got it. Somebody sent it to me or something. But anyways, title of it was "It's Go Time," in which I thought it was kind of interesting, kind of cute. But basically, Clarkson's is one of the biggest information sources for shipping industry sales rates. They do all kinds of stuff. They're basically like the Basso is to offshore oil rigs. Clarkson's is to shipping information. And what are they saying? They say, shipping markets as a whole are at a pivotal point as the effects of IMO 2020 become more apparent. That goes into effect in 6 weeks. We've talked about IMO 2020 before with the sulfur regulations and the shift from high sulfur fuel oil, which is very cheap, to low sulfur fuel oil, which is more expensive, and the mitigation strategies and how that's all going to create possible pricing and issues that are going to be reflective in higher shipping rates for some period of time. We've talked about this. So I'll send you the presentation. Basically, outlook promising across shipping industry. Why? Continued demand growth against a fast declining new building delivery schedule underpins our view that the medium-term outlook for shipping is positive. Okay? And it really doesn't really matter what's going on with trade with China and all these other things, because I'm going to get into, this IMO 2020 created significant dislocations, right? We've talked about it before, and I'll send the presentation. I'm not going to go over everything. That's causing dislocations. That's causing opportunity. The markets don't like uncertainty, but as a speculator, we look for government interventions, and International Marine Organization is a UN-based intergovernmental body that's putting out regulations for shipping, and it's creating confusion and dislocation in the industry, and that usually leads to higher prices. So an opportunity for speculators like us. Now, as I'm going to get into further in the next couple slides, there's another potential regulation coming down the pipeline in a few years also in the shipping industry around carbon emission regulation for the shipping industry. And I will get into why this shipping cycle, which I believe this upcycle we're in now, which is going to last several years, could be extended and end up having a greater amplitude because of this other regulation that's getting ready to come down the pipeline that could further constrain the supply of shipping. So I want to show this chart. It's showing you a chart of the total. This is all of the ships. We've talked about this before. Shipping is 7 or 8 different type of categories. You can't just say shipping in general, because you have everything from container ships to liquefied petroleum gas carriers to everything in between, oil tankers, cargo, like iron ore carriers, all kinds of stuff. So, but this is just taking it in totality. And why this is important is because, as we've said before, just a small change in utilization in this industry can result in oversized gains. Remember what I said before. If you have 100 cargoes that need to be hauled and you have 101 ships, then the price for all of those shipping cargoes is going to be, the cost is going to be very low, because that extra ship is providing oversupply and is going to affect the price of all the other ships. The converse is true also. If you have 100 cargoes but only 98 ships, then the price is going to be very high because you don't have enough ships to carry all the cargo, and the prices are going to be bid up because people need these cargoes moved. And that's what we've seen. We're seeing the utilization rate going up and projected to go even higher. We only need, like I said, a few percentage points changes the whole game dramatically, because of how tight supply and demand is in this industry, and how that small changes have great amplitude to shipping rates. And why are ships Why is the utilization rate increasing? Well, because of the long bear market and the overbuilding. This is a very cyclical industry. When rates go high, what do shipbuilders do? What do shipping companies do? They go out and buy more ships. They have more ships built, and then they all think the same because that's the business they're in. And they have egos. A lot of these guys have big egos. And they want to have the biggest company and the biggest ships and all this other nonsense. And so all the ships come from the shipyards at the same time. And like I said, there's an oversupply then of ships in the market, and the prices crash. And conversely, as the prices crash, the less financially stable companies go out of business, ships are scrapped, utilization rates climb again, and then rinse and repeat. The thing about it is I'm getting ready to talk about in another slide of why this is going to be extended this time. You know, this shipping bear market has been so brutal that many shipbuilding companies have left the industry and went bankrupt. Many banks will no longer finance these ships, and this other regulation on carbon is going to further exacerbate that. This is just a chart here, which I thought was interesting. So it shows the average annual demand growth for various shipping sectors, and then it shows the average new building delivery. So you see that just about in every category, except for dry bulk carriers, you see the demand growth for ships exceeding the new building deliveries that are projected. So that's positive. It's a simplistic, what they say down here in the slide, simplistic approach of recent historical demand growth trends compared to gross supply additions is in favor of ship owners. Ton miles, slippage, scrapping, etc. tighten the outlook further. We won't get into all that, but basically demand appears set to outstrip supply in coming years. We've talked about that. Now, this new CO2 emission regulation that's coming down the pipeline, I think is going to extend and exacerbate the current upcycle that I think we're entering. So, if you look over here, there's a requirement. This is around for CO2 abatement and mitigation. Obviously, CO2 is the new god that we're all praying to in the West, especially. That CO2 is the control knob for climate and all this other stuff. I'm not going to get into that argument again. Suffice to say, as far as shipping is concerned, the IMO is coming out with a new regulation, but they have not put it in place yet. So the problem is that it's not fully defined, the measurement method. Guidelines on CO2 abatement technologies have yet to be developed. Possible measures to reduce CO2, improved hull and propeller efficiency, reduce speed, lower carbon fuels, LNG and biofuel instead of, what we're being forced to use now, which is high sulfur fuel oil if you have a scrubber, or low sulfur fuel oil, which is the IMO 2020, waste heat recovery, increased cargo. So they haven't stipulated yet what the regulation is. So consider yourself in the situation of a ship owner. You own a shipping company, and rates are increasing, and you want to think about building a new ship. Okay? Now, these ships that you're going to buy and have to be financed, you don't pay cash for these, you finance them. You don't know, because the regulation hasn't been put into effect yet fully out to 2025, 2030, which is 10 years, and these ships last 25 or 30 years. So you don't know what type of engine technology. Will you be able to use slow-speed diesel, or will you have to convert to a liquefied natural gas or liquefied petroleum gas fueled ship to lower emissions? You don't know that. The technology may not even be in place. I experienced this in the fossil fuel industry. We would be working in some state where they would have this best technology statute, and for measuring things like mercury or sulfur or whatever constituent gases of the combustion process we were using for that particular power plant. And they would actually try to put regulations on us or statutes for technologies that didn't even exist at that time. And they would say, you have to comply with this measuring, and there's no instruments on the market that can measure to that lowest level. And the state was basically like, well, that's your problem, not ours. Go figure it out. It makes it extremely difficult to make new capital investment decisions if you don't know what the regulation is going to be. And I can guarantee you that if you're a shipbuilder or a ship owner or a shipping company owner, and you want to build new ships to take advantage of these higher rates that we're forecasting we're going to see, you're going to go to a bank and tell Mr. Banker, I need $50 million or $75 million to build this new tanker, but he's going to say, well, you don't, that's great, but we don't know what the regulations are going to be 10 years from now. So in the middle of the life of this ship, while you're paying back the loan, the regulations may change and the technology may be, your engines on that ship may be obsolete. So you can see what the potential is here for another dislocation due to regulations. I'm not going to get into whether the regulations are good, bad, whatever. I really don't care. That's not the basis of the decision for speculating in shipping. The decision process is that we have another dislocation caused by intervention in the market by a governmental body. Whether it's good or bad is irrelevant. What it means is, though, it causes indecision, it causes speculation, it causes uncertainty. And therefore, what you'll probably see is a lot of ships being grandfathered in, but new ships have to meet some technology or regulation that still hasn't even been promulgated or determined to this point. So no banker is going to loan money on a ship that has a 30-year lifespan, and in the middle of the lifespan of the ship, and presumably the payback on the loan, the ship may be obsolete because of the technology or the regulations that are being put out by this intergovernmental body, i.e. the IMO. So I think that is going to have an impact and exacerbate and elongate this potential shipping bull market that I think we're entering. Now, they'll eventually get it straightened out and they'll figure it out, but in the medium time, people are not going to go out and build ships without knowing what they need to build to what specification. So to wrap this up, because we're getting kind of late, here's a chart I grabbed. Somebody saw it on somebody's feed. These are some clean tanker rates. The clean tankers, as we talked about before, carry like refined products, vegetable oils, this kind of stuff. They're the epoxy or stainless steel lined hulls, tank hulls that you can carry clean things, and you don't carry crude oil in these things. And you can see that they blew up. We talked about that before. They blew up in October and then came back down. This is seasonal. Around this time every year, you see these shipping rates go up, but you see the comps, year-over-year comps, and you see, typically peaks right before the end of the year or right before December, or end of the year, I should say, going into the end of the year, and then falls back off. But you see that we had this spike, came back down to levels around last year, and now we're spiking again. This is exactly what we were forecasting and thinking would happen based on this IMO 2020 and the dislocation and confusion it would cause in the market. So I think the thesis is playing out. A lot of the stocks still haven't moved. We're seeing this all across. We're seeing this in crude oil, tankers also. So we're seeing this not reflected in a lot of the stock prices. Some of the stock prices have moved in some of these companies, but not to the extent that we think they will. I don't think this, like I said, I think this is the beginning of a long bull market because of the other things we've talked about around supply of ships and these regulations and some of the other things that are happening. So I think this will be the beginning of a multi-year bull market. And typically, like we've said before, it's not unheard of for certain stocks in this industry in a shipping bull market to go up 10, 20, 50 times in value. Not 10, 20, or 50%. 10 times, 20 times, up to 50 times. That has been the norm in previous. That's what these things do. They don't make money for 8 to 10 years, and then they go through an 18 to 36-month bull market, and they mint money like you wouldn't believe. I think we're at the beginning of one of those stages. So it would behoove you to investigate this if you're interested. We've been picking up shares of different companies in the Actionable Intelligence newsletter on shipping. We're playing it across the board. We added a tanker stock last month. We'll probably be adding a bulk carrier this month. But I would also encourage you to follow a guy at Seeking Alpha named Mintzmeyer. I will put a link to his article. He was at the this conference that I was just talking about, Marine Money, New York City. He has a pretty extensive article. He goes into even further in depth on the environmental implications of the new CO2 regulations, and he interviewed a lot of the ship owners. So I think that would behoove you to follow him. He actually has a paid service on Seeking Alpha just dedicated to shipping. I don't subscribe to it. He gives enough free information out, plus what you can find on your own, to really figure out, which stocks are the best stock buys. But I'll put a link to that. Encourage you to take a look at it. Just to end this week, because I almost forgot, nobody's really been talking about this too much, but the price of uranium, spot uranium, is up over 10% in the month of November. Don't know why. I can just speculate. Cameco probably very possibly could be in buying uranium to fill their needs. I don't know. Maybe this is just a one-off, or maybe this is the beginning of a sustained move. I think until we see the spot uranium price move over $30 a pound, the average retail investor is probably not going to be too interested. As many people have said that are smarter than me that follow this industry, spot uranium price is not really what you need to be following. Looking at what's happening in separative work unit pricing, which is up massively, and other parts of the uranium fuel chain are up massively. So that is going to tick down to physical uranium demand at some point. So some of the things we've heard just on the Twitter sphere around uranium, people that are in the know, have said that utilities now are starting to approach the miners and starting to talk about long-term deals. So this thing is, nobody cares about it. It's dead. We had all this mental masturbation going on for months and months, over the last year or so, and then it just kind of died off. That's kind of what I like to see, because now, nobody really cares. It's just the diehards, people that really get it. And I don't think you're going to get retail back into this thing till, like I said, till you see the uranium price maybe go over $30 a pound. And I also agree with, it's been my contention, I've heard a couple other people say this also, I think you're going to wake up one day and all of a sudden there's going to be a report out that somebody signed a long-term contract at $45 or $48 a pound or something like that. It's not going to tick up. It's just going to be, okay, Duke Energy or somebody that's a big nuclear operator, Southern or somebody, or FP&L came in and said, hey, we made a deal for this much uranium from this supplier for this price for the next 10 years, and that's going to kick things off. And I think, that news is probably going to be coming out eventually, because every day that we go by, we're just burning up more uranium fuel and we're not making new uranium. So there's only so much meat on the bone before we got to start raising a new cow. So patience here. I mean, the only thing I can tell you on uranium is I just keep buying the physical uranium, and a couple of the companies that I think don't need to go out and get new shares or issue new shares. I've talked about that from day one. Dilution is not the solution. So buying physical uranium, I think, is a good thing to do via UPC. You can look at Yellow Cake. You can track their NAVs, and when they go, into the negative, you could probably be picking up shares. Because what you can do is, or my strategy is buy that, and then once the bull market is certainly in effect, it's very easy just to sell those shares and just move into whatever juniors you want to move into. You might miss the initial kickoff, but when this thing gets going, it's going to be hundreds of percent. So I think buying physical uranium, putting your money in there, it's not going to go any lower than 25. We're in this range. I think you're fine, and then you just roll into whatever juniors or uranium companies once this thing really gets rolling. That's kind of been my strategy. So that's it for this week, guys. I won't be having a podcast or a video next week because of the Thanksgiving Day holiday. I want to wish everybody a happy Thanksgiving if you celebrate it. Friends and family are very important. These markets will be there when we get back, but we'll be back the following weekend after the holiday with resuming our format here on YouTube. I appreciate the support, appreciate the people, subscribers, Patreons. You know what? Throw me your questions. I'll try to answer them. I can't give. People keep asking me, "Oh, you're bullish on shipping. What stock should I buy?" You got to get the newsletter, guys. I can't just give you, or do your own research. I'm not going to give in the comments what I'm investing in. Should be obvious from some of the things that I've said or some of the company I've spoken about in the past, but we'll be expanding our names in the newsletter. And I'm just not going to give the stuff away for free. I do a lot of research. I have a lot of contacts. A lot of time goes into that. And if you want the particular names, then you just need to subscribe. So that's it for this week, guys. Thanks for listening, and we'll talk to you in 2 weeks.